We are live. Good afternoon, Crystal. How are you?
I am good. And how are you this afternoon?
Just dandy.
Cool.
Because we're starting an hour late, I took the liberty of having lunch, so I am no longer hangry. And
Okay.
that's a good day for me. That's a good day for me.
That's a good thing.
I just love being able to appreciate small miracles, you know?
Like,
So,
that's the price. That's a wonderful thing in life when you can do when you be excited about small miracles.
small miracle. Mhm. Yes, it makes me a very happy person.
Uh-huh. So
Okay, so we've got quite the thing to talk about today. You know, our topic is the four P's and target date funds. And as you know, I love talking about the four P's. Although I made the mistake of not writing them down, except for on the um, on the thing for the show. So I'm just going to write them down real quick here.
okay. That's all right.
Because I don't want to mess that up. Um, and of course, I am writing them down in reverse order as I do. That's so weird. I don't really understand. It's going to be an interesting hour. Okay.
Okay. All righty.
How about, so we're going to talk about the way to choose an investment fund in your retirement plan. Um, and then we're going to talk about target date funds and how they are wonderful and different. Is that cool?
You like it?
Okay. So how about if I read your bio first, and then we can get started? Does that work?
Sounds good.
Okay. Let's see. Of course, I did something strange with your bio. Oh, so before I say, "Hey, Crystal, talk about yourself," let me see. Let's see. What did I do with that?
I say, where is that bio?
That's just
Where might that bio be?
exactly what is up with this here. Wow. Okay. So I've got your thing here. Where? Oh, haha. I was too smart for myself. I already took it out to be ready to read. Sorry about that.
Okay.
Okay. Hello, everyone. Please help me welcome my friend and colleague, Crystal Mitchell, to Conversations on the Patio with Crystal and Jevon. I'm going to read her bio. Here we go. Crystal Mitchell is a business coach and consultant. She's the CEO of Mitchell Business Solutions, a co-director of Recycling Black Dollars. She's also the co-host of that other radio show, The Business Zone, with Crystal and Gilbert. It's another weekly online radio show. She's an instructor at Mount San Antonio Community College, a certified network for teaching entrepreneurship instructor, and a QuickBooks Pro Advisor financial strategist. Hello, Crystal. Thank you once again for joining me.
And it's always a pleasure to be here.
Mm,
Glad to
you're
be
very
here.
kind because I know I can be very boring. But thank you. I appreciate that.
And, and
Okay.
a second week into June, which is
Uh-huh.
here and moving quite rapidly through the year.
Yeah. You know, as we move through this year, I'm I'm reminded that I was supposed to be rich by now. Was that your job? Were you supposed to take care of that? Hmm. I mean,
Why did something slip?
well, it just doesn't feel like I mean, I'm very wealthy. It just doesn't feel like I am.
Well,
So,
there's been a couple of blips and the blops and blipsies
mm,
that has taken place in this year. So in the
yeah,
last 2, 3, 4 years.
I see. Yeah, so maybe
So
next year.
next year, it's coming next year.
It'll be next year. Yeah. Okay. All right. Let's get started. Okay.
Mhm.
So today we're going to talk about my favorite subject, of course, and I'm not exactly sure why it is, but we're going to talk about the four P's with regard to choosing mutual funds in your platform. And I think we did this before, but we're going to expand that just a little bit more.
Mhm.
And we're also going to get a little bit snazzy, just a little bit.
Uh-oh.
because I'm
Uh-oh.
going to try technology again.
All righty
I
then.
know, I know, but I'm going to try it again.
Okay.
So, um, the four P's are uh, product, people, price, and performance. And they're that way in a particular order. I put performance down. I'm going to say this once again. I put performance at the end because um, because they are the worst determinant of a valuable uh, mutual fund slash investment for you. The worst.
Really?
So I'm just going to say it right now. When all else fails, when the other three fail, then we choose performance. And I know that feels funky, but if you think about it, we've never had one 10-year period that I know of repeat itself, right? We've never had a 50-year period that repeated itself. So
Hmm.
the idea that something was successful 10 years ago is going to be successful 10 years from now is pretty shaky, pretty shaky. So therefore,
Mm.
you'll see those messages that say past performances do not indicate future performance. It is very true. It just doesn't work. And this is a problem for many, many people. I write what we call investment policy statements. And those are documents that a plan sponsor will use to guide themselves through the plan. So he or she may say, okay, we want to make sure that our investments reach this particular clientele. That is, they were successful in the last 5 years, or they have a 30-year track record, any number of things to prove that this is a sound investment. Unfortunately, and when they use that, I'll just go back and say when they use that so that they know when to pull something out of their portfolio and cast it aside, or when to put another fund in their portfolio. Does that make
Okay.
sense? Because
Mm-hmm.
typically, when you're in a retirement plan, you'll have a list of investments to choose from. Oh, you'll have a list of investments to choose from. Um, Sorry about that. I lost you for a moment.
Oh,
And those lists of investments should be, they should be about 15 to 18 investments plus, and I'll put it at the most, they should be 15 or 18 investments plus what we call a target date series. Okay, so
okay.
if you're the plan sponsor, you're the person that is on, and I like the way you put it, did you call it the second chapter, right?
Yes.
Your second chapter?
Third act, second
Third
act,
act. There
fourth
you go.
act,
So if you're a
fourth
person,
quarter. Some of us are in our fourth quarter.
woo,
We on glide.
somehow that sounds a wee bit predictive. I don't know if I want to get there. So I'm going to stay away from that. So if you happen to be a plan sponsor and you're thinking, okay, we're going to hire some employees, we're going to bring in that 401k plan, I'm going to be heading this up. I'm going to start saving for my retirement because for so many of us, we weren't able to save when we were working because we had stuff going on with kids
Hmm.
um, and parents and whatever.
Hmm.
So now that we're starting our own firm, we need to start paying attention to employee benefits from a different point of view, from the point of view of actually how do I use these benefits to help me grow my business rather than how do I take advantage of these benefits, right?
Hmm.
So that means you're going to get involved in discussions about the 401k plan. So eventually, once you have a little bit of money, and I typically wait until someone's got 400 or 500K, maybe even a little bit more than that, to actually write the investment policy statement. And it's just the rules of the plan. That's all it is. We'll talk about that later.
Okay.
Okay, so the thing that we want to really mention though is that when it comes to choosing the 401k plan, many times inside that investment policy statement, and that's your guide, so that you can go before the judge if you happen to get sued, and he asked you, so what reasoning do you have for leaving this fund in your plan since it's not performing? or taking this fund out of your plan because it was performing. What why did you do that? What guided you that way? That's when the investment policy statement comes into being, is very important. And that's why you ask your fund advisor or your plan manager or your crew to put that
Mm-hmm.
together so that you can have a good answer, right?
Mm.
Because remember, the main thing for an employer is to make sure that they're acting in the best interest of the participants. So, as an aside, we could say that if you are a participant in a plan and you don't think that the plan sponsor is um, acting in your best interest, that is, you don't like the funds, you don't like how much you're paying for them, uh,
Mm-hmm.
you don't like your advisor. Um, Thursday the sun didn't come up. Whatever it is, whatever it is, you have the right, and I would say maybe even, let's call it a right. I wouldn't say a responsibility, but you definitely have the right and the opportunity to go to your plan sponsor and have a conversation about that. To go to your
Okay.
boss and say, hey, what up with this? And if they don't produce an investment policy statement, shame on them, right? Because how do they figure out uh, what funds to have? Now, back in the day, the investment policy, I'm sorry, the plan sponsor would say, well, that's why I hired Jevon, the advisor, to choose the funds, right? And we have all
Mm-hmm.
kinds of designations to do that. Um, but unfortunately, even though they hired me or some other financial advisor to choose the investments,
Mm-hmm.
it's still on them. They have to sign
Mm.
a dotted line. So it makes a lot of sense. It's kind of like with your tax preparer, right? I mean, they may do the taxes, but you have to sign on the line. And they rarely go to jail for having issues on your taxes. Typically, it's the person whose taxes it is.
Right. They're the responsible party.
There you go. So, same thing with your retirement plan. If things don't go well, if things are horrible, rarely is it the advisor that has issues. Usually it's going to be the plan sponsor. Now, I'm going to get some cards and letters because there are advisors out there listening to me that suggest that they are what we call 338 advisors, which means that they take responsibility for choosing the investments, right? And 316 advisors who say, I gave them a range of the funds they should choose. There are those advisors out there. However, the plan sponsor cannot escape all the responsibility. He still has some liability. She still has to prove that she had a way of choosing these and that she stuck to it.
Mm.
So often what we see is that they have the documentation, they didn't stick to the documentation. Judges don't like that.
Okay.
Or they didn't have the documentation, they don't like that. Or they just didn't do their due diligence to document why they did what they did, right? Or right. So rarely, in fact, I've never heard of it, but rarely do we have plan sponsors being sued because they didn't have the right funds,
Mm.
right? Or the
Mm.
fund list wasn't appropriate. Okay. So that being said, and not to go down too much of a path, that being said, when you look at a plan to choose funds, what do you normally do? You haven't looked at a plan to choose funds since you've had your own business.
Right, exactly. But and when I had one, when I worked for corporate America, I was one of those individuals that we say don't be. I allowed them to do that. But on my defense, in
Mhm.
my defense, I actually worked for a financial planning firm.
Uh-huh.
And so the funds that were being chosen by our colleagues.
Okay. All right.
And so I had high regards for them, that they knew what the heck they were doing. And
Yeah.
a lot of the funds that was in that plan was some of the funds they were also recommending for their clients.
Yeah. Okay.
So I felt like I could put my money in their hands and
Yeah.
it was trusted
Yeah. That makes sense. That makes
because
sense.
that was the business that they were
That we're
in. And
in, right?
right, and so if you were giving bad information to your clients and then passing it off on your own employees, okay now.
Right? I'm right
so
there
that
with
was
you.
so that was why I put that trust in them.
Yeah. It's a great way to go, I think. Um, Many people think that if you have a financial advisor outside your plan, they ought to be able to manage the assets inside your plan. And unfortunately, that's kind of like someone coaching. Oh, I don't want to do that. I don't want to do that sports analogy. That's sort of like someone cooking chicken. They ought to be able to cook some beef. It's they can kind of do it. It's but it just isn't the same. There's a there's a there's a little bit of a difference there,
Right,
right?
right, 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 right.
So so it's best if you're going to have a 401k plan to have that advisor work with your other advisor. That's what I think. So that's
Okay.
why I work with other advisors. I have some of my favorite clients have advisors that manage their portfolio, and they manage the whole thing.
Mm.
Right? They're like, and they will come up and ask me, "Okay, Jevon, I need you to run the 401k plan because my guy doesn't want to do that. Can you help me manage just the 401k plan, or do you need to manage the whole thing?" And I, of course, say, "No, your guy is managing your whole portfolio. This is just one section of it. You've got your 401k, you've got your insurance, you've got your life insurance, you've got your regular insurance, you got your real estate, you got your 529 plans for your kids, you've got numerous things that need to be managed." And so at one point, he's or she is sort of watching over that stuff and making sure that all of those components
Mm-hmm.
work together in the right way. So I definitely love working with other financial advisors. Okay,
Which
let's
is a
get into the
team, right? I mean, it should be a
yeah, it's a
team
team.
anyway. It shouldn't
Yeah,
be everybody should be working together. You can't have the planner over here doing this thing and the retirement plan doing this thing and the CPA over there doing this thing and nobody's on point. That lose
keys
you.
with us in this industry is we typically, because I think we're afraid to get sued, and I mean everybody's afraid to get sued.
Mm-hmm.
Everybody's afraid that they're going to tell someone the wrong thing to do because they don't know the whole situation, right? I mean,
Mm.
I, as a financial advisor, I don't know what the rest of your life is like. That's why I ask folks to take their questionnaire because buyers are liars.
Mm.
Let me say that a different way. Because so many people think they think,
Retraction.
they think that the terms that they're using to describe themselves are the general terms that everybody does, and they all
Mm.
make sense to themselves.
Yeah.
So for example, if you're a moderate risk taker, then you should assume that you could receive a moderate amount of return for the amount of risk that you put out. Okay. That sounds good. But when we get down to the actual numbers, okay, on a scale of 1 to 10, are you a moderate risk taker or not? Uh, yeah. So that would put me at like 5 to 7. All right.
Mm.
Okay. What kind of return are you expecting? Anything around 30 to 40%. Okay. And what kind of risk are you expecting? Well, I'm a moderate kind of guy, so I can probably take, just below average risk, just a little bit of risk. Okay. So those numbers don't work. That's just, in the words of some of my friends, that dog won't hunt.
And that dog won't hunt.
That dog won't hunt. That chicken won't cluck. It's not going to work. So we ask people to
Oh.
do these questionnaires, um, so that we can tailor them down. But when you're looking at your whole portfolio, you may have more risk on one side than you have at another, one product than you have with another, because it's your spouse or it's your business or it's your kids or it's it's your and, whatever it is. You may have more or less risk depending on what particular thing you're talking about. And so you definitely need someone who's going to be overlooking all that and making sure those things are going, like you said so adroitly, in the right direction for yourself, right? Working together.
Right.
So let's talk about the retirement plan. Let's say you're creating a retirement plan with from your own money, or let's say you're actually in a 401k plan. So if you're in a 401k or 403b plan, some kind of employer plan, if you're looking at creating that, or if you're out on your own and you're creating a plan, then I think these rules really, really help. So I'll just put one caveat. If you're, and this is going to sound weird, but if you're looking to create your own retirement plan, because you want to do it yourself, you don't want to hire a 401k person, but you're looking to create your own long-term investment plan. So then I think we can make sense out of both of these with the same example here, versus if you're an employee and you're looking to choose your investments. Okay, so the first one we want to talk about is I've got 18 or 19, maybe 25 investments plus the target date fund. What's the first thing I ought to do? Okay, well, let's go up, and this is where the technology comes in. All right, here we go.
We're going high tech today.
Whoa, now. Can you see it?
I see it.
Yay! Okay, so I've put together this main building block is what I use every time I do every time I have a meeting rather with a client and we're looking to choose the investments for them. So first I ask them, how involved do you want to be? Do you want to have somebody else do the driving and you kind of sit back and watch the windows, or do you want to be involved in the plan? Some people are saying, I don't want to do this. I don't understand this stuff. I don't want to do it. I don't want to know about it. Just do it for me. Okay. In fact, some companies will have those options. Do it for me versus do it myself. If you want to do it for me, have someone do it for you rather. Let's talk about that in a minute. This is for those folks that say, look, nobody knows more about me than me, right? No one knows more about my money than me. Right. I want to know what's going on. I want to make the choices because I can make choices better than someone who doesn't know me. And I say, fine, let's do that. Let's take a look at that. So this is a situation where someone is choosing their investments. So you see, we've got 9 blocks for equities. We've got 6 blocks for fixed income. Does that make sense? Okay. Now we know equities. Another word for those is stocks. All right.
Okay.
And another word for fixed income is bonds. Does that make sense?
Okay.
Why we call them these other names, I'm not exactly sure, to be honest with you.
Okay.
That's the deal.
That's just the strategy for the industry, huh?
There you go. The little jargon there. So, if we look at the equities, we've got 9 boxes. One side, we've got large, medium, and small. That refers to the capitalization of the particular companies. And capitalization is the amount of worth of those companies in the stock market. So, for example, if your capitalization is 40 million, let's say, then that would mean that if we took all the stock that's in the market, we put it all in one place and we gathered it all together and added it all up, your company would be worth $40 million in the stock market. Does that make sense?
Okay.
That's what we call capitalization.
Okay.
Right. So when we talk about spreading your assets out, because I love diversification. When we're talking about diversification in the equity sector, what we're suggesting is that you fill up all 9 of these boxes with investment options. Does So I mean, you'd have a large cap growth company, a large cap blend company, a large cap value company. And when we say large cap, we mean companies that have a market value of over $10 billion.
Okay.
10 billion to around 200 billion. Now, those numbers are a little fungible, but basically about 10 billion to 200 billion. Those are large companies in the market. So we're talking about Microsoft, um, oh, those big tech companies. Maybe even who is it here? My phone. Yeah, Samsung. Big
Samsung,
technology companies.
big
Yeah,
tech companies.
big tech companies. Okay.
Okay.
So, all right. So we know we need some large companies, some medium-sized companies, and some small companies. So we're spreading our assets out. Okay. So we got to pick 3 large cap companies. So how do we do that? Okay. Well, the first thing we want to look at, if you're in a plan, and you're already you're working for somebody, how do you
Mm-hmm.
choose the first one? How do you choose that large cap growth company, for example? Okay. We're going to use our 4 P's. The first P is product. That is, what is it that you're trying to do? Oh, I need to try a large cap growth company. There's a very good chance that you only have 1 or 2 large cap growth companies to put in that box. And your job is to choose one. Make
Okay.
sense?
Mm-hmm.
All right. So let's say you chose 2 of them. That's fine. You could choose 2 of them. When you do that, you want to make sure that you're working with either your advisor or someone from the company, and I'll tell you why. Depending on your level of risk, they're going to either dial up or dial down the amount of equities versus fixed income, that is, the stocks versus the amount of bonds. So if you take that questionnaire, and that's why this is so important, if you take that questionnaire and we determine that you are a growth oriented person and we need to put 100% of your stock in um, equities,
Mm-hmm.
spread it out, still diversified, but we're going to put 100% in equities and 0 in corporate bonds. If that's the kind of person you are, then how much should we put in large cap growth? Okay. Well, most of us are going to say, um, if you do things traditionally, most of us are going to say, as an all uh, all stock person, so that's one end of the spectrum. As an all stock person, we're going to suggest that you put 70 to 80%. Some people might even say 60 to 80%, maybe 60 to 85 or 90% in that large cap growth section. And
Okay.
then the rest of them you split between medium sized companies and small companies.
Mm.
Okay. And then you're going to take that large cap growth and we're going to spread it out between the blend, which is a combination of growth and value and value. So you might
Okay.
say to me, okay, I got to put 60% of my assets, let's say, in large cap growth between growth, blend, and value. Now, why would we want to do that? Okay, well, we know that when the economy is booming and companies are growing, that being in the growth section is going to allow you to buy low and sell high, right? So
Mm-hmm.
you definitely need some growth in your portfolio. We also know that when the economy isn't booming so well, it's the value companies that kind of hang on to their value. So, for example, we don't see the stock price for Procter and Gamble, Archer's Daniel Midland, Caterpillar. We don't see those companies fluctuating as much as we see Microsoft, Dell. I don't know. I'm trying to think of another growth company. Those growth oriented companies. And the reason why is growth companies are very sexy. They like to go in, they don't like to give dividends. They like for you to buy that stock, wait for a while and sell it so you can make some money.
Right.
Right?
Okay.
Okay, so those are growth companies. So you're going to take your Microsoft money, you're going to invest it in, I'm sorry, you're going to take your money, you're going to invest it in Microsoft, and then you're going to say, okay, in 3 days, I'm going to sell this puppy and make some cash on it. All right.
Mm.
Value companies are dramatically different. Value companies are kind of like your, let's say maybe your Procter and Gamble, um, Archer Daniels, Midland. These are companies you may have heard of, you may not have heard of. They're not that sexy. I mean, when you're talking about paper, toilet paper, and Kleenexes, it ain't that big. It's just, I mean, we need them, we use them, we need everything they do, but they're just not that sexy a company, right?
Right, but they're
So
sustainable.
very sustainable, and we use them all the time, and that's why they're so big because
Hmm.
they do a great job of things that we need.
Right.
Okay. And they tend to give dividends,
Mm.
right? So if
Hmm.
you buy that, so if you buy that Procter and Gamble stack in 1970 and you keep it until 2050, every year you're going to get a dividend. And sometimes those dividends are going to split and you're going to get more stock and you're going to get more stock and then you're going to get dividends. You're getting some cash back for your investment, which is pretty cool, right?
Hmm.
When it comes to a growth company, you're not getting no cash back. You're not going to Microsoft and saying, "Okay, let me have a dividend." Microsoft's like, "No." When the stock gets to the point where you want to sell it,
You
go
just
ahead.
sell it.
Right? Because my goal is to build my stock price. They're like, I'm trying to get that stock to worth more than it was when you paid for it, so that you can make money.
Mm.
Enter
Mm.
one aspect of shareholder value, right?
Mm.
Okay, so when we're looking at this, we know we need some kind of product that's going to go between growth and value. I like using the blend column because if I can't get a specific growth company that I got to have, or I can't get a specific value company that I got to have, I can do the blend of growth and value.
Mm.
And sometimes that's a good thing for me to do. Often I do all three. Now I have a proclivity to put in that blend mix what we call index funds, and we'll have another talk about that, right? But so I like the idea of having a growth company, a company that blends value and growth, and a value company. Truth be known, you just need large cap growth, or you just need large cap companies. So you can split it up any way you want: 0, 0, 60, 20, 20, 20, 30, 20, whatever,
Mm.
10, right? You can split it up however
Hmm.
you want. And that's when the
Okay.
discussion becomes, okay, what do you want? What's going to work for you? Some people will say, well, Javon, which one should I do? And of course, my answer is it doesn't matter. It just depends on how you feel. One way I would say, if you take more risk, that is, if you lean towards the growth, the more risk, the more money you make. However, you got to sleep with yourself. And that might be tough because you know, the investment that keeps you awake at night, not a good investment.
Right.
Right. So you may have to be, I'm going to put all of my large cap stock in the value column because I'm a value investor, like a famous investor for the most part from Nebraska, kind of a
Okay.
value, right? Or you might say, you know what? I need to make my money now and I need to make it fast. Well, I don't know if that's the way things work in a 401k plan, but if you feel that aggressive, then maybe growth companies are the way for you to go. Or maybe you want a combination of both. See how that works?
Hmm. Hmm.
So
Hmm.
that's the first is the product. You've only got so many. I think you have like 18 to 20 funds to choose from. All right, choose one. We call good. So that's what we call product. The next issue, if you can't decide, let's say you got three of them, you can't decide which ones to choose. Go for the people, right? Take a look
Mm.
at those funds, see who the fund manager is, see how they like to invest. You may have to pull out that perspective and see if that fund manager's um, see if they're what would you call it, their plan or their way that they choose investments. And it'll be in the perspective how they go after companies to invest in, right? Because we know mutual funds are made up of individual equities, individual stocks. So he's going to have a way of choosing things. And if that makes sense to you versus the other plan, then that's where you want to go. Make sense?
Mm. Mm-hmm.
So
Mm-hmm.
the people, or is he one guy, or does he have a team that goes out and does things? Or
Right.
maybe it'll talk about, oh, his background was this, but now he's doing that. Well, do you want that? Or maybe he's been there for 30 years, or maybe he just got that job. He's only been there for 2 years. So none of those things are bad, and none of those things are necessarily good. But the ones that speak to you, that is how this person does their job, that's a great way to choose.
I think
Right?
so. And I think in the day, and especially in today's economy that we're in, where those individuals that's running businesses nowadays,
Mm-hmm.
you know, they're being motivated by some outside stuff, to put it
Sure.
nicely,
Yeah.
right?
Mm-hmm.
And so with that, because they're being motivated by emotional outside exterior stuff that really has nothing to do with their businesses, but it
Mm-hmm.
does have a lot to do with their capital or
Mm-hmm.
their wealth.
Mm-hmm.
There sometimes you get the impression that it's not necessarily for the betterment of the business of the company,
There
right?
you go.
Right. And if
Yep.
I'm investing, if I'm an investor, if I own shares, then I'm a bit of an owner of that company, right?
Most definitely. You're
And
exactly an owner.
I'm an owner of that company. So I want to have confidence in the person that is leading that company.
Yes.
And he or she may not have my exact um, philosophies, but I want to make sure that they're good stewards of my company,
Mm-hmm.
right?
Exactly. 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 Well said. I couldn't have said that better.
Yeah.
And, to extrapolate from that, if you've got a mutual fund manager that tends to choose companies that are, let's say, the big thing now is ESC, environmentally, socially governed companies. If you have a fund manager that tends to choose those, then that may be
Mhm.
a good thing for you. If
Mhm.
you have an investment manager that tends not to choose those, like, we don't care about that, right?
Mhm.
Then that's another indicator for you, you know, just depending on how you feel.
Right.
So the people are pretty important. It's kind of funny how now the ESG world is becoming more and more prolific at making money. There was a time in my career when we used to say, if you like, quote unquote, the planet, or staying away from tobacco, or you know, or whatever kind of thing, if you're concerned about that, then you're going to have to realize that um, many companies don't follow that, and those are the ones that are making money. They're making more
Mm.
money, let's say.
Mm.
And I've spoken with many of the investors who said, look, I don't want to support that kind of business. I want to support a business that doesn't have that. In fact, I was working at Vanguard back in the day, and this
Mhm.
woman said to me, I'm a Democrat. I do not want to support alcohol, tobacco, and firearms, and I've got tons of money. So I
Mm.
want to invest in companies that do not invest that way.
Okay.
All righty then. Well, that there you go.
And that's that person standing on their beliefs and their principles. And
Exactly.
and I always say when you do those things, you can't talk that talk. You got to walk that talk, right? So
Read
that
it.
has to go across the board. So what you invest in, how you spend your money, has to reflect what you believe in.
Well, it should.
Or should, right?
I think many of us as Americans don't do that. But if you feel strongly about it, then you have the option here, right? You have
Mhm.
the option to do that when you're choosing your investments for the most part. And if you don't see funds that uh, don't have the quote unquote bad things in them, or if you don't see funds that are ESG, environmentally socially conscious funds, if you don't see that and you want to see that in your portfolio, that's when you can go to your boss, plan sponsor, and say, hey, can we put those kinds of funds in the investment mix so that I can invest in them? And I've
Mm.
certainly had that happen.
Okay. Okay.
Certainly had that happen. And I, as an advisor, I think it's a wonderful thing to do. I've never met an advisor that didn't think that that was a good thing to do if the participants want that and it's not there already. As you know,
Mm.
the Secure Act has required investment managers to at least consider that, or I'm sorry, um, plan sponsors to at least consider that, consider investments that have that mix.
Ah.
Yeah. So there was a time when, as an investment manager, we'd say, or as a financial advisor, we'd say, they're not making as much money as these funds. So we're not going to put it in the mix. But like I was saying before, past performance does not indicate future performance. So having a balance is not a bad thing. So we can't just exclude them outright. And now we've got the Secure Act saying you better not exclude them outright.
Mm.
And also, managers of socially conscious funds are becoming quite a bit more savvy. And just as a plug, because I know we need to move on, I would say that many funds, many companies in the S&P 500, for example, we've heard of that, the S&P 500,
Mm-hmm.
they have very large socially conscious programs and environmentally sensitive programs because of their clientele. Because their clientele feel that way. And so they are choosing to be that way because of government contracts that they have, for example, which have to toe the line. So having environmentally socially conscious companies um, are not way out like they used to be, and
Mm.
it's been that way for a while.
And when you look, I mean, because that's, when you look at what's going on in the world, if you're woke, for a better sense of the word,
Mm.
um, these are the things we should be concerned about because they affect us all.
Exactly, exactly.
Yeah.
Where do you want your money to come from?
Yeah.
Where are you investing your money?
Yeah. I completely agree. I think I like that socially conscious investment.
Yeah, socially conscious investment.
Mm-hmm.
Okay, so we're cruising through our growth blend, and we're going to do large, medium, and small. We're still kind of hung up. We've got to do this large cap growth thing. We've got three products, three large cap growth funds on the portfolio, and we don't know where to put them. We've found, we've looked at the people and how they invest, and that's not helping. So it just ain't working for us. They're
Okay.
all the same. Let's say they're all the same. Okay, so what do we do? Well, the next category that we use is price, right? So if you've got one fund that's selling at $20 a share and the other fund is selling at $15 a share, and everything else is equal, the people are equal, they're all large cap growth, you can't make a decision, then I would say price is a good way to go, because if you're going to put money in the market, why not buy as much as you can?
Ah.
Right? Your dollars are going to
Okay.
go further, buy more stock. Make sense?
Okay. Makes
But
sense.
okay, but after you've gone through the first two, after all right, I can't make the decision with product. I got too many to choose from. All right, all these people sound the same. All right, let's go to price. Okay, so we've done the price thing, and we're like, they're all within $1 of each other. This is not really helping me, or 50 cents or something like that.
Mm-hmm.
What do I do now? Okay, now, since you've gone through people, product, and price, the last thing on the list, and I would say if those are the first three, this
Mm-hmm.
last one is number 27.
Okay.
Right? The last thing on the list is performance. Right? So I keep saying this, performance is not an indication, past performance is not an indication of future performance. Now, here's the deal. If you take a look at most investment policy statements, they're based on performance. Most of my clients say, okay, if I've got 3/4 of returns that are below 50% of the average, 50% of the average of all of the funds in the market,
Mm-hmm.
then it's a good reason for me to sell that product. So they write that into the code and they force us to take performance as a highlighted item with regard to that plan. That is, if I'm going to put my if I'm going to lead this plan, I'm going to put my people's money into this plan or allow them to invest in this fund. I
Mm-hmm.
want to know that that performance is at least, and I'm just choosing numbers out of the air, in the top 50%
Okay.
quartile or whatever, top two quartiles of funds,
Uh-huh.
yeah, over the last 5 to 10 years. Okay. I, as a professional, think that is in direct opposition. But like we were saying, when you don't have, it's tough to objectively manage people, and it just is, and necessarily price because that fluctuates all the time. And if you've got all kinds of product to choose from, you need some objectivity there. And so that's why a lot of people go for price. Usually in that portfolio, in that investment portfolio, there's room for someone to stick in there. Yeah, but not this fund, right? All of that, we're not going to make the decision based on price in this particular situation because we like the performance of this fund or whatever.
Mm-hmm.
And understand if you are a person that is bringing that plan on, as long as you document why you do something, your life is going to be dramatically better with regard to the Department of Labor than if you don't. So
Mm.
always err on the side of documentation. Make sense?
Okay. Makes sense.
Okay.
Makes
So those are
sense.
the 4 P's. And
Okay.
then, and that's where equity. We're going to do this, use the same 4 P's down in fixed income. We've got six. This time we've got corporate and government bonds, right? Short term, 1 to 3 years. Medium term, 3 to 7 years. Some people might say 5 to 7 years. Long term, kind of like 30 years, like your mortgage. Most people are involved in a long term investment if they own a house, right?
Right. Exactly.
Yeah.
Now,
I
why would
really
I invest in bonds? What and what exactly would those bonds look like?
Okay, so bonds are kind of confusing. They're actually lending instruments. So if you bring in a corporate bond, for example, what you're saying is, I'm going to give money to this mutual fund advisor to lend to these corporations. These corporations are going to buy these bonds and sell them back. Bonds are kind of cool, as they make money a couple of different ways. One is, in general, when you buy a bond, just kind of like when you buy a bond for a school or a parking garage or whatever it is, any type of city bond, they work pretty much the same way. You give the government money, the
Okay.
government says, okay, I'm going to borrow this money for the next 10 years, and at the end of 10 years, you're going to get money back. And through that period, usually semi-annually, every 6 months, I'm going to
Okay.
give you a interest payment. So you might give the government, all right, I'll give you $20,000, and then it's a 6% bond for 30 years. I'm just making these numbers up.
Okay.
That's like a hell of a deal. I don't think anybody's going to do
Wow. Sign me up.
right. 6% for 30 years, and then I get my 20 back. So, and so in that situation, you would get 6% of your $20,000. So, you know what, $300 every 6 months, and at the end, you get your $20,000 back. So it's not a bad deal, right?
Okay.
Okay, so When you hear someone talking about the treasury yielded X, the interest on the treasury bill went up, the yield went up. That is that interest component there. It goes up. That means that the price of those treasuries went down. So, depending on where you are in that mix, right? If you're
Mhm.
buying the bonds because you're going to hold on to them for until they mature, right? Then the interest rate going up relative to what it was when you got the thing, maybe that's not a bad idea. Interest rates are going up. But as those interest rates go up, you also have to realize the price of that bond is going down. So if you're like, okay, I've been in this bond for the last 4 years, I want to get out, and interest rates have gone up over the last 4 years, you're not going to be able to sell that bond for what you bought it for. You're going to be selling that bond at a discount. Does that make sense?
Yeah. So
So
when you look at, but when you look at having a balanced portfolio, bonds are usually included in that, right? Is that
yeah,
just for long term though? That's not, you're not looking for something, is a long term investment though, right?
well, kinda, but remember, we're talking about having equities in our portfolio and bonds in our portfolio, which you so aptly pointed out. So why would we want both?
Yeah,
Well,
why would we want both?
so equities tend to have a return of between, nowadays people say between 9 and 11%. When I was younger, it was like 9 to 12%. So let's say 9 to 11%. That's the return annually on average of equities. So if you have a year where you make 20%, you're doing really good because the average is 9 to 11.
Okay.
Bonds, on the other hand, have a annual performance usually around 6 to 5 to 8%, 5 to 8.
Okay.
Right. So someone would say, all right, so if I go all equity, the chances that I could make more money are definitely greater. And I would say yes. And then they would say, okay, so why don't I do that? I say, you can't handle that. You can't handle the fluctuation of equities. Even though you're buying large cap value stocks, you can't handle that fluctuation. It's going to keep you up at night. So what do? You put those bonds in there so that as you're putting your money out, they don't fluctuate as much. You
Oh,
don't
okay.
you don't make as much money, but you can sleep at night.
Okay. So give you some stability
It's a little bit
or
of stability.
some peace of mind.
Peace of mind, right? So you can look
Okay.
at it and say, okay, this is what happened to the stock portion of my portfolio. Oh my gosh. Oh, but this is what happened to the bond portfolio. So the whole thing wasn't horrible. Yeah. All right. Well, unless we have some time like, or some instance like 2008, where there was no place to go. I mean, bonds were tanking, equities were
Mhm.
tanking, the whole country was having a major problem. But inside that, as you know, I'm going to say, wait a minute, this is an opportunity to buy low, right? Because if we're a long term investor, we're not just in the market for a long term. If we're a long term investor, we're in the market for a long term, but we're going to take advantage of market ups and downs. And the way
Mm,
we take advantage of market downturns is to buy cheap. Right?
mm.
Right. So if you want to keep your sanity when it comes to investing in the market, especially in a retirement plan, be that in a 401k plan or your own retirement plan, using the four rules, I'm reading them now. Product, product, people, price, and performance, using the four P's and understanding that long term means taking advantage of market downturns, then perhaps you get to spend a little bit more time licking your lips and going, yay, rather than, oh, God, this is horrible. I'm losing all my money.
Very. I like the simplicity.
Oh, good.
in explaining it, and how why you do need to have this balance and what each one of them do. Yeah, excellent, excellent. So choosing the right one, because I think that's, and even myself, or anybody that's not in your, stay in your field, or in the stock or financial planning field, or stock market, you know, a lot of people are interested in investing in the stock market, but it's very frightening, right? Or and you don't really know, you know, do you go eeny meeny miny mo? You know, what's the strategy of it? Everybody, you hear everyone saying buy low, you know, but you know, as
Mhm.
we talk about that all the time, what does that really mean? Right?
Sure.
Right? You know, there's some stock right now that have, you know, that have changed dramatically in the last couple of years. Probably is the time folks supposed to be jumping in. But then exactly when do you get out, right?
Yeah.
So unless you're watching it all the time. So, and should you get out, like you said, should you take your money out, or should you just let it sit there and ride a little bit, especially depending on, you know, whatever your future plans are.
Yeah. That, however, is another show.
That's another show. Another show. Another show.
We'll talk about that later.
Yes.
But it's a very, very good question. When do you get in? I mean, it's one thing to say I like to buy low and sell high. It's another thing to say time to buy low, time to sell high, right?
Right.
Right. So,
Exactly. But like that simplicity.
yay, good, good, good. Okay. Um, well, I have taken more of your time than I was supposed to, and please forgive me for that. But if we don't end this quickly, the folks at StreamYard will just cut us off. So,
We don't want that.
no, those folks are no joke, right? Okay, so I'm gonna quickly read your
Hmm.
bio, and I'm gonna give you the last word. Is that cool?
Okay.
Okay, here we go. So, everybody, this is Crystal Mitchell. Well, it's a part of Crystal Mitchell. There's a lot more to you than this, but here we go.
Hmm.
She is a business coach and consultant, the CEO of Mitchell Business Solutions, a co-director of Recycling Black Dollars. She's the co-host of the Business Zone with Crystal and Gilbert, a weekly online radio show. She's an instructor at Mount San Antonio Community College, a certified network for teaching entrepreneurship instructor, and a QuickBooks Pro Advisor financial strategist. Thank you, Crystal, for being here. I am Jevon Thomas, a licensed retirement plan advisor, and it is my honor to give Crystal the last word on our little theme.
Aw. This has been a great show, Javon. Really helped clarify on how to successfully create pick, choose, or select the right investment for your portfolio, um, preferably for your retirement portfolio. I thought it was very clear. So, again, guys, you know, having your team, and as Javan said at the early part of this, you know, he likes to collaborate with a financial planner, as well as for you, so that you need to talk, have a, make sure your teammates are all having conversations for the betterment of you and on your behalf. Really important, because you know, can't have four different people going in four different directions. All right.
Cool. Well
So
said. Well said. Well, with
collect
that,
collective and collaboration.
and
That's what I want to
collaboration.
end on.
There you go. I like it. I liked it. With that, we will see all of you next week, right? Are you going to be with us next week, Crystal? Next week?
Well, next week is Juneteenth.
Juneteenth. So maybe not next week.
Yeah, next week, the
So
week after,
week
because I'm
after.
yeah, the week after, because I'm actually flying out to London next week.
Oh, yeah, yeah, yeah. That's right.
Yeah.
Yeah,
Hmm.
good for you. Well,
Hmm.
safe travels, friend.
Thank
All
you.
righty. That's it.
All right.
Thank you.
Bye
Talk to you
bye,
guys.
everyone.